Fund Supermart, your online gateway to unit trusts.
The funds currently are most focused on the themes of paperless payments and internet transformation. The paperless payments theme is focused mostly on the move away from cash towards credit and debit cards, and that is increasingly also towards mobile payments. The introduction of Apple Pay in November in the US brought mobile payments to the forefront of investors' minds, but it's one that we've been focused on for some time. The internet transformation theme is a theme that we've focused on for a large number of years, and we think that although we saw the tech bubble, the dot-com bubble in 2000, it's only now that the internet is really fulfilling its promise in investment terms. We very much look for companies that are benefiting from their critical mass and are actually achieving barriers to entry through their size and network effects. In the social space, people are increasingly spending more time on the internet. Facebook wasn't around 10 years ago, and now it has 1.4 billion users who spend 25% of their time on the internet on Facebook, over 20 minutes a day. There's a gap between the amount of time that people spend on the internet and the amount of advertising dollars that are spent on the internet just now, and we're focused on companies that can help close that gap, companies that have the potential to monetize that. And we like the theme of video on demand or video over the top on the internet, as consumers increasingly seek advertising free channels such as Netflix. Netflix and Amazon have both embarked upon a strategy of developing original content, which has driven consumers to their platforms both in the US and internationally. The technology sector has outperformed broader equities since the financial crisis. So valuations are admittedly not as attractive as they were a number of years ago. We still think on a price to earnings basis, the sector offers relative value compared to the broader equity market, because the technology sector is still growing earnings faster than broader equities, and is also been growing its dividend yield much faster than the rest of the market. Balance sheets remain very strong. So structurally, we remain very positive on the technology sector. The technology sector spends more in terms of R&D than any other sector, and that drives productivity gains, and we believe that drives a structurally higher growth rate. Equally, over the last 70 years, we've seen the percentage that's spent on technology equipment and software increase as a percentage of GDP quite gradually over that longer term time period. But within that, there are periods of overinvestment and periods of underinvestment. And since the financial crisis, we've seen underinvestment as companies have gone through a process of asset sweating that's lengthening replacement cycles. We think that can't carry on indefinitely, so that gives us some optimism that we will see a pickup in spending on capital equipment, particularly as we see labour costs start to rise. There are, however, some near-term headwinds. The move in the dollar over the last 6 months has been quite dislocative, particularly for technology markets. Most of technology is actually priced in dollars, but budgets, particularly in EMEA, are in local currency, and that can take a while to catch up. Even if we look out towards the second half of the year, even if we were to assume that the dollar and euro were to go to parity, we're really seeing the worst of that effect take place now, and that should improve through the remainder of the year. We continue to focus on the powerful themes that we mentioned earlier, and continue to monitor earnings revisions and valuations on a bottom-up basis, and focus on those companies with the highest barriers to entry and the best management teams that we think can exploit those trends most effectively.